The Bloomberg Commodity Index is approaching a compulsory reweighting event that cannot be postponed, negotiated, or avoided. This is not an opinion-driven adjustment, nor is it influenced by forecasts or discretionary judgment. It is a mechanical process embedded in the index's rules, and it must be executed exactly as written. As the calendar turns, the numbers involved have drawn the attention of professional traders across global markets. Billions of dollars worth of exposure in precious metals must be reduced within a narrow time window. Silver alone faces sales exceeding $7 billion, while gold will see nearly the same amount pushed out of index-linked portfolios. When combined, the total forced selling surpasses $14 billion, all concentrated into roughly one trading week. This scale of activity is not common, and when it appears, it tends to distort markets regardless of fundamentals. What makes this event especially significant is not merely the dollar value involved, but the proportion of the futures market it represents. Internal analysis circulating among institutional desks indicates that the required silver liquidation equates to a substantial percentage of open interest in near-dated futures contracts. In practical terms, this means a large fraction of existing positions must be unwound in a compressed time frame. This type of activity does not wait for favorable conditions. It does not respond to technical support levels or momentum indicators. The selling occurs because it must, not because it should. This is the defining feature of structural selling. Unlike discretionary trades where participants can adjust size, timing, or execution, structural flows are rigid. They move through the market regardless of price impact. The mechanism behind this process is straightforward but often misunderstood. Commodity indices maintain strict allocation limits to prevent any single component from dominating the index. When a commodity experiences a strong year, its weight naturally grows. If that weight exceeds predefined thresholds, the index methodology requires a reduction back to target levels. Funds that track the index must comply. They sell exposure until balance is restored. This process happens with clockwork regularity, and yet its consequences are often underestimated by those unfamiliar with index mechanics. The timing of this particular rebalance places it squarely in the spotlight. The selling is scheduled to begin after the market closes late in the week, with the full impact expected to materialize as trading resumes the following morning. By then, liquidity conditions may amplify the effect. Traders who understand how forced flows behave have already begun adjusting. Some are lightening leverage, others are preparing capital to deploy if prices overshoot to the downside. Many participants, especially outside institutional circles, remain unaware of what is approaching. Recent price action has already hinted at underlying stress. After reaching elevated levels, silver pulled back sharply, shedding several dollars in a short period. To casual observers, this appeared to be routine profit-taking. To those tracking positioning and flow data, it looked like the early stages of adjustment. Price patterns on longer timeframes still show consolidation rather than breakdown, but the intrusion of compulsory selling changes the character of that consolidation. Instead of organic pauses driven by balanced supply and demand, the market now faces an external shock. Earlier in the rally, similar periods of sideways movement resolved higher once selling pressure was exhausted. That history matters, but it does not eliminate near-term risk. The question now is whether incoming demand will be sufficient to absorb the forced liquidation without triggering secondary selling from leveraged players. There is capital waiting on the sidelines, particularly from those who missed earlier advances. However, demand is not evenly distributed across all forms of exposure, and this is where the distinction between paper and physical markets becomes critical. The index does not hold bars or coins, it holds financial representations of metal. Futures contracts, fund shares, and derivative instruments make up its exposure. These instruments can be created, traded, and extinguished with ease. Physical metal cannot. This difference underpins the divergence now developing. While paper exposure faces imminent selling pressure, physical supply is already constrained. Retail dealers are reporting depleted inventories. Products that once shipped within days now carry extended delivery estimates. Premiums have expanded well beyond historical norms, signaling scarcity rather than surplus. This creates a paradox. A decline in paper prices does not necessarily translate into cheaper physical metal. If futures prices fall sharply, buyers may rush to secure tangible supply, overwhelming dealers who have little inventory left. In such cases, premiums rise to ration what remains. The nominal spot price becomes less relevant to anyone seeking actual metal. This phenomenon has occurred before during periods of market stress, but the current environment differs in one crucial respect. Supply chains are already stretched. Refineries are operating near capacity. There is limited ability to respond quickly to surging demand. As these dynamics converge, the market is effectively splitting into two separate arenas. One is the electronic marketplace where contracts change hands in milliseconds. The other is the physical marketplace where delivery constraints, fabrication capacity, and logistics dominate. Price discovery no longer occurs in a single unified system. Instead, it fragments. What happens in one arena does not immediately or fully translate to the other. This fragmentation challenges long-held assumptions about how commodity markets function. The coming days will test whether this separation widens or narrows. A sharp paper sell-off could expose the fragility of derivative pricing when confronted with physical scarcity. For those focused solely on charts and screens, this may appear chaotic. For those focused on long-term preservation, it may simply confirm what has been building for years. Structural imbalances do not resolve quietly. They surface through volatility, dislocation, and forced adjustment. The approaching rebalance is not the cause of these imbalances. It is merely the catalyst that brings them into view. The idea that markets always move according to fundamentals is comforting, but it is not always accurate. In reality, some of the most violent price movements occur when fundamentals are temporarily overwhelmed by structure. What is unfolding now sits squarely in that category. The approaching wave of forced selling is not responding to supply, demand, or valuation. It is responding to rules written years ago that now activate automatically. This is why the situation feels disconnected from logic for many observers. Prices can fall sharply even when long-term conditions remain supportive, simply because a mechanism has been triggered and cannot be turned off once it begins. As trading desks prepare for the execution window, liquidity becomes a central concern. When large volumes must be transacted within a short time frame, execution quality deteriorates. Orders hit thin books, spreads widen, and price slippage increases. This is particularly true in futures markets, where many participants operate with leverage. When prices move against those positions, margin requirements rise. Some traders are forced to liquidate not because they want to, but because they have no choice. This secondary liquidation can amplify the initial move, turning what began as a mechanical adjustment into a broader sell-off. These cascades are not theoretical, they are recurring features of modern markets built on leverage and automation. At the same time, algorithmic systems respond to volatility rather than intent. They do not differentiate between structural selling and a shift in fundamentals. When prices break through technical levels, automated strategies often increase selling pressure, accelerating momentum. This can create the illusion that sentiment has suddenly turned bearish, even when the underlying drivers remain unchanged. Human traders watching these moves may misinterpret what they are seeing, reacting emotionally to what is at its core a mechanical process. This misinterpretation is where opportunity and risk intersect. As paper markets react almost instantly, physical markets move at a different pace. They are constrained by inventory, logistics, and production capacity. This lag creates tension between quoted prices and real-world availability. When futures prices drop sharply, physical buyers often step in aggressively, viewing the move as an opportunity rather than a warning. Dealers facing limited supply respond by adjusting premiums instead of prices. The result is a widening gap between what screens display and what buyers actually pay. This gap confuses those who assume the spot price tells the whole story.
Evidence of this divergence is already visible. Many popular physical products are unavailable or backordered. Delivery timelines have stretched from days to weeks. Premiums that once seemed excessive have become the norm. These signals suggest that physical demand has not weakened despite recent price volatility. Instead, it has intensified. Buyers appear less concerned with short-term price fluctuations and more focused on securing metal before it becomes even harder to find. This behavior contrasts sharply with the actions of paper traders, who can exit and re-enter positions with minimal friction. The coexistence of these two behaviors highlights a deeper shift. Silver is no longer being treated solely as an industrial input or a speculative trade. It is increasingly viewed as a form of monetary protection. This perception changes how participants respond to price movements. When an asset is seen primarily as a trade, falling prices discourage buying. When it is seen as insurance, falling prices encourage accumulation. This distinction explains why physical demand can strengthen even as paper prices weaken. The motivations are fundamentally different. Historical precedent offers insight into how such periods resolve. In previous episodes where paper and physical markets diverged sharply, the disconnect eventually forced a repricing. Either paper prices rebounded to reflect physical scarcity, or physical premiums collapsed as supply caught up. The outcome depended on whether supply constraints were temporary or structural. In the current environment, many of the constraints appear persistent. Mining output has not surged. Refining capacity is limited. Above-ground inventories have been drawn down over years. These factors reduce the likelihood of a quick normalization. Another layer complicating the picture is the broader macroeconomic backdrop. Precious metals do not trade in isolation. They respond to currency dynamics, interest rate expectations, and confidence in financial systems. When real yields are low or falling, the opportunity cost of holding non-yielding assets diminishes. When debt levels rise faster than economic output, concerns about currency stability grow. These conditions have been developing over an extended period, and recent policy signals suggest they are not reversing. This context matters because it frames how market participants interpret volatility. A pullback in a strong macro environment feels very different from a pullback in a fragile one. Geopolitical developments add another dimension. When international norms weaken and asset seizures become more common, trust in paper claims erodes. Investors begin to question not just returns, but access and control. Physical assets that sit outside financial systems gain appeal under these conditions. This does not mean prices rise in a straight line. It means demand becomes more resilient. Temporary sell-offs are met with buyers who view them as rare chances rather than reasons to exit. As the forced selling event approaches, narratives will compete. Some will frame any decline as the end of a rally. Others will see it as a necessary purge of excess leverage. Both interpretations may coexist, but only one aligns with the structural realities beneath the surface. Markets often attempt to shake out participants before resuming a dominant trend. This process can be uncomfortable and disorienting, especially for those focused on short-term movements. Yet it is a recurring feature of long-duration advances. The key distinction lies in time horizon. Those operating on days or weeks may experience heightened risk as volatility spikes. Those operating on years may see little change in their thesis. The same price movement can be interpreted as danger or opportunity depending on perspective. This is why understanding market structure is as important as understanding price. Without that context, reactions become reactive rather than strategic. What unfolds next will likely reinforce lessons that markets have taught repeatedly, but that are often forgotten. Prices do not always move because value has changed. Sometimes they move because rules demand it. When those rules collide with constrained supply and shifting perceptions, the results can defy expectations. The coming period will not simply test price levels, it will test assumptions about how markets function and where true value resides. The pressure building beneath the surface of the silver market cannot be understood in isolation from the broader financial system.
What appears on screens as volatility in a single commodity is in reality the visible edge of much deeper stresses. Modern markets are interconnected in ways that magnify shocks. When one segment experiences forced movement, the effects ripple outward, influencing currencies, bonds, equities, and confidence itself. The current episode is a reminder that markets are not purely rational pricing machines. They are complex systems shaped by leverage, rules, psychology, and political realities. One of the most overlooked aspects of the present situation is how dependent price discovery has become on derivative markets. Futures contracts, options, and exchange-traded products dominate volume. Physical transactions represent only a small fraction of daily activity. This imbalance works smoothly when confidence is high and supply chains are flexible. It breaks down when stress emerges. In such moments, paper prices can move far beyond what physical availability would justify. This does not mean derivatives are meaningless, but it does mean they are vulnerable to distortion when structural flows overwhelm organic trading. As forced selling unfolds, the behavior of large institutions will shape outcomes. These players manage risk differently than individuals. They operate within mandates, regulatory frameworks, and internal controls. When volatility rises, risk models may demand reduced exposure regardless of outlook. This can lead to synchronized behavior across firms, further intensifying moves. At the same time, some institutions specialize in absorbing such flows. They step in not because they believe prices are perfectly valued, but because they understand that forced sellers are temporary. Their willingness to buy depends on balance sheet capacity and confidence that the broader system remains intact. Retail participants experience these dynamics differently. Many interact with the market through simplified narratives. Prices rise because demand is strong. Prices fall because demand is weak. Structural events challenge this narrative. When prices fall sharply despite bullish headlines, confusion sets in. Some interpret the move as proof that prior beliefs were wrong. Others double down, convinced that manipulation is at play. The truth is usually less dramatic but more complex. Markets can move counter to fundamentals for extended periods without invalidating long-term trends. Physical buyers occupy a separate psychological space. Their decisions are influenced less by intraday charts and more by availability and trust. When shelves are empty and delivery times extend, price becomes secondary. This behavior introduces rigidity into demand. It does not disappear when prices dip. In fact, it can intensify. This rigidity contrasts with the flexibility of paper demand, which can vanish instantly when sentiment shifts. The coexistence of rigid physical demand and elastic paper supply creates unstable equilibria. These imbalances are not limited to silver. They reflect broader changes in how value is perceived. For decades, financial assets benefited from declining interest rates and expanding liquidity. This environment rewarded leverage and paper claims. As debt levels grew, confidence in perpetual stability became embedded in pricing. That confidence is now being questioned. When trust erodes even slightly, preferences shift. Tangible assets gain relative appeal, not because they promise extraordinary returns, but because they promise permanence. Monetary policy plays a central role in this shift. Central banks face constraints that did not exist in earlier eras. Debt burdens limit their ability to raise rates aggressively. Political pressures limit tolerance for economic contraction. As a result, policy responses increasingly favor accommodation. This bias shapes expectations. Even when officials signal restraint, markets often anticipate eventual easing. This anticipation influences asset allocation decisions long before policy changes occur. Precious metals tend to benefit from such expectations, even if short-term moves appear contradictory. Geopolitical tensions add another layer of uncertainty. When international relations deteriorate, trade flows are disrupted, sanctions proliferate, and legal norms weaken. Assets once considered safe become contingent on political alignment. This reality encourages diversification away from claims that depend on cooperation between states. Physical commodities held outside the financial system fit naturally into this shift. They do not rely on counterparties in the same way that claims do.
This independence becomes valuable precisely when cooperation declines. As these forces converge, the silver market becomes a microcosm of larger transformations. Forced selling events expose fragilities that are otherwise hidden. They reveal how much of market stability depends on continuous inflows and confidence. When those flows reverse, even briefly, prices can gap violently. Observers who focus solely on outcomes may miss the underlying causes. Understanding those causes does not eliminate volatility, but it provides context that can prevent overreaction. The coming weeks will likely see heightened debate about what recent price action signifies. Some will argue that the market has peaked, others will claim that the volatility proves the system is broken. Both views may capture elements of truth without capturing the whole. Markets can be both volatile and structurally bullish. They can be distorted in the short term and repricing in the long term. Holding these ideas simultaneously is uncomfortable but necessary. Ultimately, the significance of current events lies less in precise price levels and more in what they reveal about market structure. When paper markets dominate pricing but physical markets constrain reality, tension builds. That tension resolves through adjustment. Sometimes prices move, sometimes premiums move, sometimes both. The path is rarely smooth. For those watching closely, these moments offer insight into how value is rediscovered when assumptions are tested. They remind participants that markets are not static systems, but evolving reflections of trust, scarcity, and human behavior. As attention shifts beyond immediate technical pressures, the macroeconomic landscape comes into sharper focus. The environment in which silver trades today is shaped by forces that extend far beyond commodity cycles. Fiscal dynamics, demographic trends, and political incentives interact in ways that make long-term stability increasingly difficult to maintain. These pressures do not always manifest as crises. Often they appear first as subtle distortions, growing imbalances, and repeated reliance on temporary fixes. Public debt levels illustrate this pattern clearly. Over time, governments have accumulated obligations that